Ever wonder what really happens behind the closed doors of Wall Street's biggest banks? Are investment bankers the ruthless deal-makers portrayed in movies? Or is there more to their high-stakes world? Today we're pulling back the curtain to reveal the true roles and responsibilities of these financial powerhouses. Stay with us to uncover the secrets of investment banking and find out what makes this profession so essential and so intriguing. Today we're diving deep into the world of investment banking. What do investment bankers actually do? You might have heard of them from movies like The Wolf of Wall Street or news about big financial deals, but what's their real job? Stay tuned as we uncover the intricacies of this high-stakes profession. First, let's start with a basic understanding. Investment banking is a sector of the financial industry that deals primarily with raising capital for companies, governments, and other entities. It's divided into several key areas, including corporate finance, mergers and acquisitions, M&A, sales and trading, and asset management. Investment bankers help clients with major financial undertakings, from issuing stocks and bonds to managing complex M&A transactions. Their expertise allows companies to navigate the complexities of the financial markets and secure the funds needed for growth and expansion. Now, let's break down the different roles within an investment bank. Analysts and associates, these are entry-level positions typically filled by recent graduates or those with a few years of experience. Analysts and associates are the workhorses of the bank, handling the grunt work like financial modeling, preparing presentations, and conducting market research. They spend long hours crunching numbers and gathering data to support senior bankers in making strategic decisions. Vice presidents, VPs, after a few years as an analyst or associate, one might be promoted to a VP. VPs play a more significant role in managing client relationships and overseeing the work of analysts and associates. They begin to take on more responsibility for pitching deals and coordinating the execution of transactions. Directors and managing directors, MDs, these are the senior-most roles in investment banking. Directors and MDs are responsible for sourcing new business, maintaining client relationships, and leading large transactions. They bring in the deals that analysts and associates work on, and they have the final say on strategic decisions. Each role is critical to the bank's operations, and as you move up the ladder, the focus shifts from technical work to client management and deal-making. Key functions of investment banking. Next, let's explore the primary functions of investment banking in detail. Corporate finance. Corporate finance is one of the core functions of investment banking. It involves helping companies raise capital through equity and debt offerings. This can include initial public offerings, IPOs, follow-on equity offerings, and bond issuances. During an IPO, an investment bank helps a company go public by issuing shares to the public for the first time. This process involves valuing the company, preparing regulatory filings, marketing the shares to investors, and finally, pricing and selling the shares. For bond issuances, the bank assists in structuring the debt, setting the terms, and selling the bonds to institutional investors. The goal is to ensure that the company gets the best possible terms for its capital needs. Mergers and acquisitions, M&A. M&A is another critical area. Investment bankers advise companies on buying, selling, or merging with other companies. This involves extensive due diligence, valuation analysis, and negotiation to ensure that the deal is beneficial for the client. For example, in a merger, the investment bank will analyze the financials of both companies, identify potential synergies, and help negotiate the terms of the merger. The goal is to create value for shareholders by combining two businesses into a more efficient and profitable entity. Sales and trading. Sales and trading is the heartbeat of the financial markets. Investment banks have teams of traders and salespeople who buy and sell securities on behalf of clients. Traders execute trades while salespeople develop relationships with institutional investors and provide them with market insights and investment opportunities. This function is essential for providing liquidity in the markets and helping clients manage their investment portfolios. Asset management. Finally, asset management involves managing investments on behalf of clients, which can include individuals, corporations, and institutions. Investment banks offer a range of investment products and services, from mutual funds to customized portfolio management. Asset managers work to achieve the best possible returns for their clients, balancing risk and reward according to each client's investment goals. So what does a typical day look like for an investment banker? It varies depending on the role, but let's take a closer look at the day of an analyst. 6 a.m. an early start is essential. Analysts often begin their day by catching up on financial news and market updates. This helps them stay informed about any developments that might impact their work. 8 a.m. arrive at the office. The first task is usually to review any updates from ongoing projects and prepare for the morning meeting with the team. 9 a.m. team meeting. This is where the team discusses current projects, assigns tasks, and sets priorities for the day. Analysts might present their research findings or updates on financial models. 11 a.m. working on financial models and presentations. Analysts spend a significant portion of their day building and updating financial models, preparing pitch books, and creating presentations for clients. 2 p.m. client meetings and calls. Depending on the project, there might be calls or meetings with clients to discuss progress, present findings, or pitch new ideas. 4 p.m. more work on deliverables. The afternoon is often spent refining presentations, conducting additional research, and making any necessary updates to financial models. 8 p.m. evening wrap-up. As the day winds down, analysts review their to-do lists, prepare updates for their supervisors, and plan for the next day. 11 p.m. finally, it's time to head home. Long hours are typical in investment banking, especially during busy periods like deal closings. As you can see, the life of an investment banker, especially at the junior levels, is demanding and requires a significant time commitment. But for many, the rewards and career opportunities make it worthwhile. The skills required. Now, let's talk about the skills that are crucial for success in investment banking. Analytical skills. Investment bankers need strong analytical skills to assess financial data, build models, and make informed recommendations. Attention to detail precision is critical in this field. A small mistake in a financial model or presentation can have significant consequences. Communication skills, whether it's writing reports, giving presentations, or negotiating deals, effective communication is key. Teamwork. Investment banking is highly collaborative. Success depends on working well with colleagues and clients. Work ethic. The hours are long, and the work can be intense. A strong work ethic and resilience are essential. These skills, combined with industry knowledge and a strategic mindset, enable investment bankers to navigate complex financial landscapes and deliver value to their clients. The impact of technology. Technology is transforming investment banking. From algorithmic trading to advanced financial modeling software, tech innovations are reshaping how bankers work. Technology is enabling more efficient trading, better risk management, and deeper data analysis. Tools like AI and machine learning are helping bankers predict market trends and make more informed decisions. Embracing these technological advancements is essential for staying competitive in today's fast-paced financial environment. With great power comes great responsibility. Investment banking has faced its share of ethical challenges, from conflicts of interest to market manipulation. High-profile scandals have underscored the importance of ethical conduct in this field. Banks have implemented stricter regulations and compliance measures to ensure transparency and integrity. Ethical behavior is not just about following the rules. It's about fostering a culture of honesty, accountability, and respect. This is crucial for maintaining client trust and the long-term sustainability of the financial system. Historical financial scandals in investment banking. Investment banking has played a crucial role in the global financial system, but it has also been associated with several significant scandals over the years. These scandals have often highlighted issues of ethical misconduct, regulatory failures, and the immense influence of investment banks on the economy. Below, we explore some of the most notorious financial scandals involving investment banks. 1. The South Sea Bubble 1720. The South Sea Bubble was one of the earliest financial scandals and involved the South Sea Company, which was granted a monopoly to trade with South America by the British government. Investment banks of the time played a role in inflating the company's stock price through speculative trading and misleading information. Impact: the bubble burst led to widespread financial ruin for investors and a significant loss of public trust in financial institutions. Aftermath: the scandal resulted in stricter regulations and oversight in the financial markets. 2. The Great Crash of 1929. The Wall Street crash of 1929, which led to the Great Depression, was partly fueled by speculative practices and rampant margin trading facilitated by investment banks. Banks were heavily involved in promoting and selling overpriced stocks to the public. Impact: the crash wiped out billions of dollars in wealth and led to unprecedented unemployment and economic hardship. Aftermath: this event prompted the creation of significant financial regulations, including the Securities Act of 1933 and the Securities Exchange Act of 1934, which established the Securities and Exchange Commission (SEC). 3. The Enron Scandal 2001. Enron, an energy company, used complex financial instruments and off-balance sheet entities to hide debt and inflate profits. Several major investment banks were involved in helping Enron structure these financial instruments and raise capital, despite clear signs of financial irregularities. Impact: the scandal led to the bankruptcy of Enron and massive financial losses for investors, employees, and pensioners. Aftermath: it resulted in the Sarbanes-Oxley Act of 2002, which aimed to improve corporate governance and financial disclosures. 4. The dot-com bubble, late 1990s, early 2000s. During the late 1990s, investment banks aggressively promoted and underwrote initial public offerings (IPOs) for technology companies with little regard for their financial viability. This led to a massive speculative bubble in tech stocks. Impact: the eventual bursting of the bubble resulted in significant losses for investors and a severe downturn in the technology sector. Aftermath: the scandal led to increased scrutiny of the IPO process and the role of analysts in promoting stocks. 5. The subprime mortgage crisis 2007 to 2008. Investment banks played a central role in the subprime mortgage crisis by packaging high-risk mortgages into complex financial products like mortgage-backed securities (MBS) and collateralized debt obligations (CDOs). These products were sold to investors worldwide, often with misleading assurances about their safety. Impact: the crisis triggered a global financial meltdown, leading to the collapse of major financial institutions, massive government bailouts, and a severe global recession. Aftermath: the crisis resulted in significant regulatory reforms, including the Dodd-Frank Wall Street Reform and Consumer Protection Act, aimed at preventing future financial crises. 6. LIBOR Scandal 2012. Several major banks, including Barclays, UBS, and Deutsche Bank, were found to have manipulated the London Interbank Offered Rate LIBOR, a benchmark interest rate used in financial contracts worldwide. Impact: the manipulation affected trillions of dollars in financial contracts, leading to significant financial and reputational damage. Aftermath: this scandal led to widespread regulatory changes and fines, as well as reforms in how benchmark rates are determined. 7. The Goldman Sachs and 1MDB Scandal 2015. Goldman Sachs was implicated in the One Malaysia Development Berhad 1MDB scandal, where billions of dollars were embezzled from the Malaysian Sovereign Wealth Fund. Goldman Sachs helped raise funds for 1MDB through bond sales, despite red flags about the fund's integrity. Impact: the scandal led to multiple criminal charges, significant financial penalties for Goldman Sachs, and political upheaval in Malaysia. Aftermath: it underscored the need for stricter compliance and due diligence in international financial transactions. These scandals highlight the critical importance of ethical conduct, robust regulatory frameworks, and transparent financial practices in the investment banking industry. While investment banks play a vital role in the global economy, these historical events serve as reminders of the potential consequences of unethical behavior and inadequate oversight. Understanding these past scandals helps in comprehending the current landscape of financial regulation and the ongoing efforts to maintain the integrity of the financial markets. In conclusion, investment banking is a complex and dynamic field that plays a crucial role in the global financial system. Despite its challenges and demanding nature, it offers significant rewards and career opportunities for those who possess the right skills and mindset. Thank you for watching. If you found this video informative, please like, share, and subscribe for more insights into the world of finance.